Hello, and welcome to the last video. The last topic. I've still got, I think, 3 videos, at least 3, maybe 4. It depends how much time I spend on the Excel spreadsheet. There's only going to be 2 videos for the lecture notes, but the Excel spreadsheet I've decided to do on the fly, so you can see me actually doing it real time. It might take a long time. Anyway, well done for getting to the end of this module. And this is the last topic. So am I sharing my screen? Yeah, share my screen. Here I am. And we are going to be talking about portfolios, the risk management, looking at diversified portfolios, checking the volatility of portfolios, value at risk, other type of risk, market risk metrics. We've looked at operational risks in crypto assets, but we haven't really looked at market risks. So that's what we're going to do in this video. And then the next video is about portfolio optimization. And I've chosen this picture because it's something that I got from the internet, because companies are now beginning to specialize in fund managers for crypto assets. And this is an interface of one particular hedge fund that uses Markowitz portfolio optimization. Okay, so these are the 2 videos. The first one, this one, is on measuring market risk. And this little graph here shows actually something from a GARCH model. We're not going to be looking at GARCH models, but that's what we call a conditional statistical volatility model. We'll look at a baby GARCH, a UMA, exponentially weighted moving average. And anybody who has actually done my market risk module, my financial risk management module, will find this part very easy. So there are 3 lines here. Each one represents a volatility. I'll explain what a volatility is later. And what we can see is that on the whole, apart from at this point here, this stops in January 2019, but in the end of 2018, there was an increase in volatility, but otherwise volatility seems to be going down. And these are broad market indices. They're a bit like the S&P 500, only for crypto assets. There's one with CoinGecko, one with CoinMarketCap, and one with Crypto Compare. And you can see that they have this ordering because it depends on the number of assets. The more assets you have in measuring an index, the less volatile it is. So, for example, you'll find something like the CAC 40 stock index with 40 stocks is more volatile than the FTSE 100 with 100 stocks because of this diversification effect. I'll talk about that now. So let's start from the very beginning with some simple notation. We're actually going to be having to look at probability distributions. But before we do that, what are we looking at the distribution of? Well, either returns, you know what that is, or a profit and loss. And you should know what that is, but I'm defining them here anyway. So profit and loss is just the change in price. So it's measured in nominal terms like dollars, or it depends. I mean, if you're looking at the Bitcoin price of Ether and the Bitcoin price of Ripple or whatever it is, then your profit and loss would be in Bitcoin. But more often than not, at least at the moment, we tend to measure things in dollar prices whenever we can. So your profit and loss would be in dollars. But the return is the relative price. So, for example, over a risk horizon of H days, the H day profit and loss is the price H days from now. So I'm looking forward. When we're measuring risk, we're always sort of, rather than looking at backwards differences, we look at forward differences. So it's a difference from something forward minus the price today. And of course, this price, T plus H, is a random variable. We don't know what it is. So the profit and loss is also a random variable. After the event, we can record it. But right now, there's a distribution that we have in our minds about this future profit and loss. It could be anything from minus 50% to plus 50% at the moment. Sorry, that's on the returns, the percentage on the returns. But Bitcoin, I mean, it just hit around 18,000. So the one-day profit and loss could very easily, it could go down to 17 or even 16,000. It could go up to 20,000 in a day. It's so volatile. This is the price of Bitcoin in USD. So the fundamental driver of risk, I mean, risk is actually uncertainty in our probability distribution of returns going forward, or our probability distribution of profit and loss, is the volatility. And we have to be careful about whether we use returns or profit and loss. We can always use profit and loss, any situation. But in some cases, for example, hedge funds might be long Bitcoin and short Ether, for example. And in that case, depending on their portfolio weights, how much they have, what proportion of assets is in Bitcoin and the proportion that's in Ether, that's the portfolio weights. It could be that the value of the portfolio is zero, in which case you've got, well, it could be negative as well, and that doesn't make much sense if you've got a negative price. You can have when you've got a long-short portfolio, though. And in that case, when you divide by zero, you get something infinite. And when you divide by something negative, it doesn't really make sense. So returns only really make sense when the price is always positive. Otherwise, we'll use the profit and loss. So volatility is like the standard deviation, which you'll all know about, the standard deviation of returns or P&L, but we quote it in annual terms. So in case you forgot, the standard deviation is the square root of the variance, okay? Now we annualize our standard deviation using the square root of time rule, because it's the square root of the variance. The variance and the mean and covariances all scale with time, but the standard deviation scales with the square root of time. What do I mean by scales with the square root of time? Well, suppose we've got standard deviation of H-day returns, say weekly returns. And if we're just looking at crypto markets, that would be a 7-day return because crypto markets are open 24/7. But if we've got returns on gold or S&P 500 or something like that, that would be a 5-day return, okay? So suppose that H is either 7 or 5, depending on what we're looking at. And suppose there are N trading days per year. So in gold or S&P 500, there are about 252 trading days. I say about 250 because it's an easy number. But for crypto markets, N is 365, or to be precise, 366 in a leap year, but let's forget about that. So the square root of time rule is that the volatility, which is the annualized form of a standard deviation, is this sigma h times the square root of n divided by h. For instance, if the standard deviation of daily returns, so h is 1, daily returns, is 2%, then the volatility is going to be this 2%, that's your sigma 1, times the square root of 365. Or, let me do another calculation here. I'll change my video to my little USB camera for a moment. If you've got the standard deviation of weekly returns, so we say Bitcoin US dollar returns, Well, in that case, H is 7 because it's Bitcoin. It would be 5 if it were the S&P 500. And N is 365, not 250. And that would be our sigma 7, yeah? And say it's equal to 4%. Then the volatility is equal to 4%, that's the sigma 7, times the square root of 365 over 7, which is square root of 52. Because there are 52 weeks in a year. And I don't know what that is, but something like 30% about. Hello again. Okay, so how do we measure this standard deviation? Well, there are two ways, an equally weighted method and an exponentially weighted method. And I'm going to do these in an Excel spreadsheet, so you'll see it actually happening in practice. Now, you may remember the formula for a sample variance. Okay, I'm going to keep calling it sigma, not S squared, because just sloppy notation actually, but just to avoid introducing too much notation. So you will probably remember this formula. Sample variance is equal to 1 over n minus 1, the sum of xi minus x bar all squared. Now, I'm going to call it sigma squared, and I'm going to assume that this x bar is 0, which means I don't have to take 1 off. The reason I took 1 off in that formula is because I had to calculate x bar before I could calculate s squared. So I lost 1 degree of freedom. So this is the formula that I've got here on that side, okay? Now, let's just assume that we've got RT is a daily return, okay? Or we could have R7T or something for a weekly return, but just suppose, but normally when we're measuring volatility, we do like to take daily returns or even higher frequency. It could be an hourly or whatever. You know, we have pretty high frequency data in crypto markets. And then we're going to look backwards. So here we are now. We're going to look historically at this time series. Okay, these are our daily returns there from the beginning of our sample, and then they go on and on and on. And for the equally weighted method, this first method at the top, we take a chunk here, say n of them. And so at this point here, say that's time t. Then we use this formula here, sigma t squared. It's very similar to that, only we make it sigma t squared is equal to 1 over n, and the objects are our returns from yesterday. That's the first one, assuming this is in the morning and then we don't see the closing price. So it's the sum, in this case it was I equals 1 to n for the sample size up there, and here it's I equals 1 to n as well, because we've got, okay, so that's, in other words, it's RT minus 1 squared plus RT minus 2 squared plus plus RT minus n squared, all divided by n. And we can move it along. It's called an equally weighted moving average. If then on the next day, say this day t is Monday, and then we knock 1 off there, we keep the window size fixed, and we go to the next day and we call that time t, and then we get another sigma t. That gives us a whole time series of these things as we roll through the sample. Okay. Now that's all very well, but suppose, I mean, we're looking at squared returns here, yeah? We're not really worried about anything other than the squared returns because that's all that goes into the calculation. So suppose our squared returns look like this. Well, the actual returns look like this, got a big positive return or a big negative return. Both can happen quite a lot in crypto. So they go like that. And then when we square them, we've got something very, very little. I'm doing this day by day now. And then a really big one, and then quite little. And then we've got another really big one. And then we've got, you know, more squared returns getting more volatile and going down like that. Okay, so suppose that's RT squared. When we take our first, we start taking our window size n, and it's there, and it's there, and it's there. And then we get to a point here when suddenly that's size n, and our sigma t squared gets really, really big because you've got one big observation in the sample. And then we carry on going that window, and so on and so on, until we get to a point where suddenly here, it's suddenly dropped out of the sample and we're back to having a sample without it. So at this point, this sigma t squared is suddenly going to be low, whereas the red sigma t squared is going to be high. So the effect on our sigma t squared is that it's very small here, and then suddenly it shoots up on that day, on that red day, there. And then on that blue day, exactly n days later, because our sample size is n, this is n days, it stays up because it's got that, and then suddenly it jumps down. But absolutely nothing happened on that. Well, there's another one there, so it would jump up again, okay? But I call these things ghost features, because when you get a big jump like that, which often happens in crypto markets, you've suddenly got a very high volatility for exactly whatever it is, 30 days or 90 days or however long it is that you are measuring the sample, however many days you have the sample. So that's not very good. And the problem really is that you've got this, this calculation, the big return comes in suddenly there. And then just before it goes out, it's here, and then it goes out of the sample. But all the time, it's got the same weight. It's always got equal weights. It's an equally weighted average of squared returns. So what can we do about that? Well, have a look at this formula. And here it is again. Sigma t squared is RT minus 1 squared plus RT minus 2 squared plus RT minus n squared. Okay. And it's divided by n, which is the sum of the weights. N is 1 plus 1 plus 1 plus 1 plus 1 plus 1. Suppose now instead we introduce some lambda where lambda is less than 1. Say, it has to be positive, so it's somewhere between 0 and 1. And we multiply these things, this one by lambda squared, and so on and so forth, and this one by lambda to the n. Okay? And then we can add up lambda plus lambda squared plus lambda to the n. And actually, that's the sum of the weights. Now, we can also write that as RT minus 1 squared plus just 1 lambda, RT minus 2 squared, plus just lambda to the n minus 1, because we can cancel a lambda and divide all of that by not lambda, but 1 plus lambda, divide lambda through every term. And that's RT minus n squared. But those of you who've done mathematics at A-level, not everybody will remember that this is 1 over 1 minus lambda. That means that, forgetting about this thing there, we can rewrite this as 1 minus lambda on the top times RT minus 1 squared plus all that. And we can keep going on, but you know, when lambda is less than 1, when n is large, this is going to be very, very small. So let me just carry it on. And this is called the UMA. And take it from me, doesn't take long to show, but I've shown you enough. I know you don't need to know all this. All you need to know is a little bit of algebra here. Allows you to write this formula as 1 minus lambda times RT minus 1 squared plus lambda times, this is what we call the recursive form. And we can put that in an Excel spreadsheet. And the difference between this and the equally weighted model is that you don't have an equal weight on this return throughout the entire sample. The weight goes down as you move through the sample. And so instead of having this sort of thing, you have that sort of thing. It sort of gradually diminishes. And that's much more how volatility should behave. And so that's why we like this other exponentially weighted moving average. And this lambda, which is called the smoothing constant, it controls two things. It controls, first of all, if lambda is high, then 1 minus lambda is low. Say lambda is 0.5, because that's actually a very low value for lambda. Then it means that there's not very much, if lambda is 0.5, then there's not very much persistence, but there's more reaction. Because the squared return will have a bigger effect than, say, when lambda is 0.9. If lambda is 0.9, then on this first term here, you've only got a weight of 0.1, but 0.9 is the weight on yesterday's variance. And that makes it more sort of persistent. I'll explain what it does when I do it in the Excel spreadsheet. Easier to see in action. So here's a little graph of Bitcoin and Ether volatility based on the equally weighted model with n equals 30. You can see these ghost features I was talking about, particularly in Ether at the beginning. And here, look, in July. And volatility has been going down over that period. But I'm going to be, in my Excel spreadsheet, I've got data up to yesterday or today, up to today. So we'll get some more up-to-date figures about, I mean, the volatility was 100%, more than 100%, but it was coming down closer to sort of standard things like commodities have volatilities quite often up to about 50%. Let's see what it is more recently, later on when we look at the Excel. Now, if we use the UMA model, this is with lambda as 0.8, you can see that instead of the ghost features, the volatility jumps up and down. A little bit more realistic, but still it's a very sort of jumpy volatility. That's because lambda's 0.8. If I made lambda 0.9, then it'd be smoother. It wouldn't be so up and down all the time. Anyway, we can, I should put my video back on. Am I going to? Yes, I'm going to put my video back on. Hello again. Here's a scatter plot to introduce the concept of correlation. And you've probably seen something like this before. So on each point, it represents the same day, the return on Bitcoin and the return on Ether. And from this scatter plot, you can see that they tend to go hand in hand. Most often, if the return on this axis here, that's the return on Bitcoin, is positive, then so is the return on Ether. So a lot of the points are in this quadrant. Or if the return on Bitcoin is negative, then so is the return on Ether. It doesn't always happen. I mean, there's all this stuff here where there's a positive return on Bitcoin but a negative return on Ether, or a negative return on Bitcoin and a highly positive return on Ether. So, but there's a general tendency for one to go up when the other goes up and one to go down when the other goes down. And that means there's a positive correlation. So what do we mean by covariance and correlation? Well, they're measures of the co-movement between two returns. So just as the variance is an average squared return, covariance is an average of cross products. So in the equally weighted model, I'm not going to do the Eumer model here, but in the equally weighted model, instead of the return squared, you take the product of R1, that's the return on Bitcoin, and R2, that's the return on Ether. And you sum up those cross products over the last n days. And that gives you something called sigma 1, 2, which is the covariance. And that can be positive or negative. In the scatter plot I just showed you, it was quite likely to be positive. Now, the trouble with covariance is that you might get a number that is 0.0004, but it's actually really significant because like the returns themselves, they depend on the unit of measurement. So you could get a very, actually, no, the returns don't depend on the unit of measurement because they are relative returns. But if you did a covariance on a profit and loss, that would depend on the unit of measurement. So if you measured in dollars, you might get a very small number, but if you measured in cents, you could get a very large number for exactly the same thing. So in order to take any units away completely, we divide the covariance, which is, if this were a P&L rather than a return, that would be dollars times dollars. And then the standard deviation is in dollars. And so we take away all the units of measurement. And this produces something called a correlation, which basically measures the same thing as covariance, the degree of association between the two variables. But it doesn't have any units of measurement, and it always lies between -1 and +1. If you get a result that doesn't lie between -1 and +1, then you've made a mistake. It can be +1, but only if they're what we call perfectly correlated, which means that these scatter plots would lie exactly on a line. The slope of the line has nothing to do with it because you could always change the units of measurement here and say, instead of putting it like 0.4, I'm going to make it in basis points or something like that. So you could always elongate either axis and that would squash things down or make it look steeper. So the perception of the slope has nothing to do with correlation. It's whether or how closely they are along a line. Unless, of course, the line is definitely completely flat. That means that one of your variables is not a random variable. It always takes the same value. So that's no point in measuring co-movement when it doesn't move. Now, we may want to use crypto with other data. And daily closing prices, that's all we can get for other data. We can get hourly or minute prices for crypto, but for other data, we have to have daily closing prices. And the daily closing prices on crypto are recorded usually at midnight UTC every day of the year. But other financial assets, the daily closing prices are recorded when the market closes. For example, the closing prices on FTSE 100 stocks is 4 p.m. London time, or the closing prices on the New York Stock Exchange are 4 p.m. Eastern Standard Time. So if you want to have effective portfolio diversification, for example, adding crypto to diversify the risks of US equities, then you need to measure the correlation properly. And you can't measure the correlation unless you've got absolutely contemporaneous data, because if they're out of sync, you're not measuring like with like. So if data are daily, you've got to be quite careful about the time when you measure the data. Make sure that you take the crypto data, not daily closing prices, but 4 p.m. London time or whatever it is. And forget the weekends, because the markets won't be open unless it's weekend. So sometimes when we're looking at cross assets, we prefer to actually take, particularly across time zones, like Asian stocks and American stocks or something. We tend to use weekly data and maybe measure them on Wednesday or on Friday. There will be a few hours difference, of course, between those closing prices, but on a weekly basis, a weekly return can be bigger, much bigger than a daily return. So a small error doesn't make such a difference when you've got a big thing. Okay, so now I'm going to be talking about value at risk. And those of you who are doing my financial risk management module will find this bit very straightforward, because this was already like the fundamental part of the market risk part of the module. So what I've drawn in this diagram here is a very wiggly distribution for the H-day profit and loss. So the units will be dollars or something like that. So the profit is in the right and the loss is in the left. And value at risk concerns a loss. What we want to find is some level here of loss. So I've said minus VAR, because VAR is a positive number representing a loss. For example, if our value at risk is $2 million and it's a one-day value at risk, that means that we're fairly sure we won't lose more than $2 million over the next day if we don't change the portfolio. In other words, if we don't rebalance the portfolio, or if we don't change the number of Bitcoin we hold and buy and sell other assets, okay? That's a rebalancing. Assuming we don't rebalance our portfolio, a VAR of $2 million means that we're fairly sure that we won't lose more than $2 million. But what do I mean by fairly sure? Well, in this density here, deliberately drawn it so it's not normal, the probability of getting something in this bold area to the left of VAR, minus VAR, is the shaded area. So say the shaded area is 5% of the total area, and minus VAR is minus 2 million. In other words, VAR is 2 million. So this number here is minus 2 million. That means that I'm 95% sure, that's the rest of this, that I won't be there, that I won't lose more than 2 million over the next, well, it can be an H-day P&L, in which case it's over the next H days, and that H is called the risk horizon. So formally, the alpha percent H-day VAR is the loss from holding the portfolio over an H-day risk horizon that is equaled or exceeded with some probability alpha. Okay, so that's the definition of value at risk. And why did I do it? It's because everybody measures risk in terms of value at risk and volatility. Those are the two things that you need to know, volatility and VAR. Now, there are two methods I'm going to explain for measuring value at risk. And first of all, I'm going to take these critical values of the standard normal distribution that you'll be familiar with, like 1.96. So the lower quantile at 2.5% is 1.96. Let me just draw a normal distribution. So these are the features of a standard normal distribution. The mean is 0. By the time you get to plus 1.96 or minus 1.96 or 1.645 or minus 1.645, let's have a look at those two. So this area and this area together make 5%. So that's 2.5%, and that's 2.5%. And for the 1.645, this area and this area are each 5%, or together they're 10%. And similarly, you can go up to just have like 1%, that's minus 2.33. That's the one we use quite often in value at risk, is the minus 2.33 and the plus 2.33. So this area is 1%. And this area here is 1%. Okay, that's a picture of Z, the standard normal variable. Mean 0, variance 1. Okay, so suppose that the H-day P&L is normally distributed not with mean 0 and variance or standard deviation 1, but we use this notation, mu H and sigma H. Then this is the formula for the alpha percent H-day var. The alpha comes from this. So if alpha is 2.5%, we use 1.96 for minus Z alpha. If alpha is 1%, we use 2.33 or 2.3263. So for a 1%, we'd use 2.3263 for this minus Z alpha here. We almost always assume that this mu is 0. So it's just the sigma H that we need. So we can convert a volatility, instead of converting the H-day standard deviation into an annualized volatility, we can convert it into an H-day var. Okay. So, for example, if the daily P&L has standard deviation 1, 2, 3, 4, 5, 6, then the 1% daily var is 2.3263 times 1.2, 1, 2, 3, 4, 5, 6, which is this. And we can use that square root of time rule to change the daily standard deviation into an H-day standard deviation, and therefore make this into an H-day var by multiplying it by the square root of H for any H. Typically, we might use H is 10. Here's another example. Suppose we measure var using returns, not the P&L. We normally do that, particularly something like Bitcoin, which has been trending quite a lot. It seems to have lots of bull markets and bear markets. When it trends like that, it's best not to use returns, because at the moment, you know, a return of 1,000 is like a 5% return. But 5 years ago, a return of $1,000 was like a 500% return, you know. So the absolute returns are not so commensurable between different years when the level goes up and down. So we usually measure var using the returns, and then we convert the percentage var to a dollar var just by multiplying the percentage var by the current portfolio value. For example, suppose the volatility is 50%. That's an annualized standard deviation, remember, the volatility. Find the 1% 10-day normal var of a portfolio which is valued $3 million invested in Bitcoin. So the 10-day standard deviation, that's the first thing. So it's 50%, and we've got to convert it back to a 10-day. So we divide by 365 and multiply by 10, and that gives us this number here. So that's my 10-day standard deviation. But now I have to multiply it by 2.3263 to get the 1% VAR. So that's 19.2526%. Oops. And that's only in percentage terms. Since I've got $3 million invested, then my VAR is 19.2526% of $3 million. And so when I multiply those two together, I get 577,578. Note, I kept a lot of decimal places here because this is large, $1 million. So if I rounded it, then I wouldn't have had the same to the exact dollar. So I didn't round it there. So this is a 10-day value at risk for Bitcoin over this period we saw before. It looks very like the UMA volatility because all I've done is taken that UMA volatility and then applied that calculation to make it into a 1% 10-day VAR at every point in time. So it wasn't 50% all the time, but whatever that volatility was, I went through these calculations and I just did this now just in percentage terms. So you can multiply this by any nominal you like. It doesn't have to be 3 million because this is the percentage VAR. And the other method is perhaps a little more suitable for Bitcoin and Ether and other crypto, because when you look at the empirical histogram of the returns on Bitcoin or any portfolio, then it tends not to be normal. Doesn't look like that bell-shaped curve I just drew. It tends to have these heavier tails and big outliers like down there. And if that's the case, then the normal VAR may not be very accurate. So suppose the 5% quantile of empirical portfolio daily returns is, say this is 5%, you can see this number minus 0.017 on the axis here. And then if you add up all those heights, it comes to 5% of the total. So that's what we call the 5% quantile. So that means, you just read it straight off, that if that's 5%, then minus that number, or 0.017, is the 5% VAR. And if they are daily returns that you've drawn here, it will be a daily VAR. If they are weekly returns you've drawn here, it will be a weekly VAR. So, and then we can just multiply it by the current portfolio value. So if the 5%, this is daily returns, the 0.017 is the minus 0.017 is the lower 5% quantile, then the 5% daily VAR is 1.7% of the current portfolio value. So if the portfolio value is 2 million, then we come up with 34,000 as the 5% daily VAR. In other words, we're fairly sure that we won't lose more than 34,000 over the next day if we don't do anything, if we don't rebalance the portfolio. We're fairly sure. How sure? 95% confident that we won't lose more. If it was a 1% daily VAR, we'd be 99% confident. And so the number would be bigger. We'd have to go way down here to 0.027. And it would, so the 1% daily VAR would be 2.7% of 2 million, which is a bigger number. All right, that's it. And I'll see you in the Excel spreadsheet.